If you hold silver, stop what you're doing. Close the other tabs, put your phone on silent. Because what I'm about to show you is the single most important data point that has crossed my screen this year. I'm not being dramatic. I'm not trying to scare you. I'm trying to prepare you. Because today, a number was published. A number that was supposed to be routine. A number buried inside a weekly report that 99% of investors will never read. But that number changes everything. This morning, the COMEX warehouse report updated. And when I pulled the data and compared it to last week, I had to check it 3 times. I thought there was a glitch. I thought the spreadsheet was broken. But it was not broken. The number is real, and it tells a story that the banks, the brokers, and the mainstream financial media are desperate for you to ignore. Today, I'm going to show you exactly what happened. I'm going to walk you through the data line by line. I'm going to explain why this single report confirms what we have been quietly tracking for months. And I'm going to tell you what it means for the price of silver, for the stability of the paper market, and for every person holding physical metal right now. Stay quiet, stay focused. This matters. Let me get straight to the data. No speculation, no opinion, just the numbers. Every business day, the CME Group publishes the COMEX Warehouse Inventory Report. This report tells us exactly how much silver is sitting in the approved vaults in and around New York City. The report is divided into 2 categories, registered and eligible. Registered silver is the metal that is specifically available for delivery against futures contracts. If someone buys a silver future and demands physical delivery, the registered metal is what they receive. This is the frontline inventory. This is the silver that backs the paper promises. Eligible silver is metal that is stored in the vault but belongs to private holders. It is not available for delivery unless the owner reclassifies it. Now here is what happened today. The registered silver inventory dropped by 3.7 million ounces in a single reporting period. One day, 3.7 million ounces gone, moved out of the registered category. To put that in perspective, the total registered inventory before today's report was approximately 48.2 million ounces. After today, it sits at roughly 44.5 million ounces. That is a 7.6% decline in a single day. Let me say that again because the speed matters. The registered inventory lost nearly 8% of its total in 24 hours. Now you might say, well, maybe it was reclassified to eligible. Maybe someone just moved it from one category to another on paper. And yes, a portion of it was reclassified. But here's the part they do not want you to focus on. Over 2.1 million ounces did not reappear in the eligible category either. That metal left the vault entirely. It was physically removed, loaded onto trucks or planes and taken somewhere else. This is not a paper adjustment. This is a physical drain. Real metal, real trucks, real destinations. And we need to understand where it went and why it went there today of all days. But before I trace the metal, I need you to understand why the 44.5 million ounce number is historically terrifying. Because context is everything in this market, and the context is screaming. In 2021, the COMEX registered silver inventory peaked at over 150 million ounces. That was the comfortable level. That was the buffer that allowed the paper market to function smoothly. Banks could sell futures, knowing that the vault had enough metal to cover any reasonable delivery demand. Today we sit at 44.5 million ounces. That is a decline of over 70% from the 2021 peak. And the rate of decline is not slowing down. It is accelerating. The drain is getting faster, the exits are getting larger, and the people taking the metal are not speculators. They are not flipping contracts for a quick profit. They are permanent buyers. They are taking the silver, and they are never bringing it back. So let us follow the trail. Where does 2.1 million ounces of physical silver go when it leaves a COMEX vault in New York? There are 3 primary destinations, and each one tells us something critical about the state of the global silver market. Destination 1, Shanghai. The Shanghai Futures Exchange has been the black hole of global silver for the past 18 months. Metal flows into Shanghai and it does not come back. Chinese industrial buyers, solar manufacturers, electronics producers, and increasingly state-linked entities are importing silver at a pace that is straining global logistics. Here's the data point that ties directly to today's COMEX drain. The Shanghai premium over the London spot price has been consistently running between 5 and 12% for the past several weeks. Today, that premium spiked to over 8%. What does that mean in simple terms? It means that buyers in Shanghai are willing to pay 8% more than the global benchmark price just to secure physical metal. They are paying a premium because the metal is scarce. And when you are paying a premium in Shanghai while the COMEX is being drained in New York, the conclusion is obvious. The metal is moving from west to east. It is moving from the vaults that back the paper market to the factories that consume the physical metal. And here is the critical distinction. When silver goes to a solar panel factory in Jiangsu province, it does not come back. It is consumed. It is soldered onto cells. It is embedded in panels that will sit on a rooftop for 30 years. That silver is permanently removed from the investable supply. Every ounce that leaves COMEX for Shanghai is an ounce that will never be available for delivery again. Destination 2, India. India imported over 10 million ounces of silver last month alone. That number has been trending sharply higher for 18 consecutive months. Indian demand is driven by two factors: industrial consumption in their rapidly growing electronics and solar sectors, and traditional investment demand from a culture that has treated silver as money for 5,000 years. The Indian buyer is patient. They buy on dips. They buy on rallies. They buy consistently. And they store it privately, outside the banking system, in family vaults and safety deposit boxes, where it will never appear on any exchange report again. Destination 3, private off-exchange storage. This is the flow that is hardest to track, but potentially the most significant. Wealthy individuals and family offices are moving metal out of exchange-affiliated vaults and into private storage facilities in Switzerland, Singapore, and New Zealand. The reason is counterparty risk. They watched what happened on the London Metal Exchange during the nickel squeeze in 2022. They watched the exchange cancel trades, change rules, and protect insiders at the expense of honest market participants. And they decided they do not want their metal sitting in a vault controlled by the same institutions that are short the market. This is rational behavior. If you believe that the exchange might default or change the rules during a crisis, the logical move is to remove your metal from the exchange before the crisis hits. And that is exactly what we are seeing in the data. The eligible category, the private metal, is also declining, not as fast as registered, but steadily. People are pulling their silver out of the system entirely. Now, let me connect these three flows to the number that matters most: the coverage ratio. The coverage ratio is a simple calculation. You take the total open interest in silver futures, the total number of contracts outstanding that each represent a claim on 5,000 ounces, and you divide it by the registered inventory. This tells you how many paper claims exist for every physical ounce available. 3 years ago, the coverage ratio was approximately 2-to-1, 2 paper claims for every physical ounce. That was already uncomfortable, but manageable. Today, after this morning's drain, the coverage ratio has spiked to over 7-to-1. 7 paper contracts claiming ownership of every single registered ounce. If even 15% of those contract holders decided to stand for delivery simultaneously, the vault would be empty. Not low, empty. 0 ounces available. This is not a theoretical risk anymore. This is a mathematical certainty waiting for a trigger. And the trigger could come from anywhere: a geopolitical escalation, a banking crisis, a currency shock, or simply enough industrial buyers deciding that they need the metal more than they need the paper. Now, I want to address something that I know many of you have seen today, because within hours of this COMEX report dropping, the financial media began running a very specific narrative. And if you do not understand why they are running it, you will fall into the trap. The headline I saw on 3 separate financial outlets this afternoon said something to the effect of "silver pulls back as profit-taking kicks in." And beneath that headline, the talking heads on financial television began their predictable routine. They said silver is overbought. They said the rally is overextended. They said smart money is taking profits and rotating into other assets. Let me be very clear about what is actually happening versus what they are telling you is happening. The paper price of silver did dip today. It fell approximately 2% during the New York trading session. Now, in a vacuum, a 2% dip is nothing. It is noise. Silver moves 2% on a quiet Tuesday. But the timing of this dip, when paired with the COMEX data, reveals something much more calculated. When 3.7 million ounces are drained from the registered vault and the paper price goes down, not up, you are not looking at a free market. You are looking at a managed market. You are looking at entities selling paper contracts. Contracts that are not backed by physical metal, specifically to suppress the price signal that should be screaming shortage. Think about the logic. If I told you that a store just lost 70% of its inventory of a product that is in record demand, you would expect the price to go up. That is basic supply and demand. But in the silver market, the inventory drops 70%, and the price is lower than it was 2 years ago. That is not economics, that is intervention. The purpose of today's price dip is psychological. It is designed to make you, the silver holder, doubt your position. It is designed to make you look at the screen, see the red number, and think, maybe I should take my profits. Maybe the rally is over. Maybe I was wrong. You were not wrong. The data confirms you were right. The price is a short-term manipulation. The inventory is a long-term reality. And long-term reality always wins. Always. But the manipulation serves another purpose beyond psychology. It serves a mechanical purpose. When the price dips, the margin requirements for the short positions decrease. The banks that are short silver need less cash to maintain their positions when the price goes down. So by engineering a dip today, on the same day that the vault drain accelerated, they are buying themselves time. They are reducing their immediate cash needs while the physical foundation of the market crumbles beneath them. This is the behavior of a trapped animal. It is not the behavior of a confident institution. Confident sellers do not need to manipulate the price. They sell at market and let the price find its level. The fact that they are actively managing the price tells you that the real price, the price that would exist without intervention, is substantially higher. And here's the second piece of data that contradicts the mainstream narrative. While the paper price was falling today, the physical premiums at major dealers were rising. I checked 6 major online bullion dealers this afternoon. The average premium over spot for a 100-ounce silver bar increased from $2.80 yesterday to $3.40 today. For American Silver Eagles, the premium jumped from $7.50 to $8.20. If the rally were truly over, if profit-taking were really driving the market, the premiums would be collapsing. Dealers would be flooded with metal from sellers cashing out. The shelves would be full and the premiums would shrink. The opposite is happening. The shelves are thinning. The premiums are expanding. The wait times for certain products are stretching from days to weeks. The physical market is telling you the exact opposite of what the paper market is telling you. And in a market where the paper claims outnumber the physical metal 7-1, which signal do you think is telling the truth? Now I want to zoom out because today's data point does not exist in isolation. It is part of a pattern that has been building for 4 consecutive years. And when you see the pattern, you understand why this particular drain feels different from the ones that came before. The global silver market has been in a structural deficit since 2021. According to the Silver Institute, the cumulative deficit over those 4 years now exceeds 600 million ounces. That is 600 million ounces of demand that was not met by mine supply and recycling. Those ounces had to come from somewhere. They came from the above-ground stockpiles, they came from the ETFs, they came from the COMEX and LBMA vaults. They came from the reserves that were supposed to provide a buffer for exactly this kind of situation. But buffers only work if they are replenished, and the silver buffers are not being replenished. They are being drained to zero. The 44.5 million ounces sitting in COMEX registered today is not a healthy inventory. It is the last line of defense. It is the final backstop between an orderly paper market and a disorderly physical crisis. And the demand side is not easing. It is intensifying. Let me give you 3 data points that crossed my desk in just the past 7 days. First, China announced the approval of 14 new solar megaprojects totaling 85 gigawatts of capacity. Each gigawatt of solar capacity requires approximately 800,000 to 1,000 ounces of silver. Those 14 projects alone will consume between 68 and 85 million ounces of silver over the next 24 months. That is nearly double the current COMEX registered inventory consumed by a single country's solar program. Second, India's government extended its production-linked incentive scheme for domestic electronics manufacturing. This program is expected to increase India's industrial silver consumption by 15 to 20% annually for the next 5 years. Third, and this is the one that fascinates me the most, the U.S. Department of Energy published a report identifying silver as a critical mineral for national security. Let that phrase sink in. Critical mineral for national security. This is the same language they use for rare earth elements, for uranium, for lithium. When a government classifies a commodity as critical for national security, procurement behavior changes. Strategic stockpiling begins. Export restrictions are discussed. The commodity transitions from a market-driven asset to a geopolitically managed resource. Silver is making that transition right now, and the 3.7 million ounce drain from COMEX today might be a tiny piece of that puzzle. We do not know who took the metal. The data is anonymized. But when governments start classifying a commodity as strategically critical, and simultaneously that commodity starts disappearing from exchange vaults at an accelerating rate, the quiet investor connects those dots. This is why the mainstream narrative of profit-taking is not just wrong, it is dangerously wrong. It is designed to keep you focused on the daily price candle, while the structural foundation of the market shifts beneath your feet. The price is a distraction, the inventory is the reality. So what does today's data mean for you specifically? What should a silver holder do with this information? First, understand what you own. If you hold physical silver, you hold something that is increasingly scarce, industrially essential, and now classified as strategically critical. The value of what you hold is not determined by the number on a screen. It is determined by the number of people who need it and cannot get it. That number is growing every single day. Second, understand the game that is being played. The paper market and the physical market are telling 2 different stories. The paper market says silver is pulling back. The physical market says silver is harder to find, more expensive to acquire, and in higher demand than at any point in modern history. These 2 stories cannot coexist forever. At some point, they converge, and when they converge, the adjustment will not be gradual. It will be sudden, disorderly, and violent. Third, understand the timeline. I do not know if the convergence happens next week or next quarter. Nobody does. But what I do know is that the runway is getting shorter. At the current rate of drain, the COMEX registered inventory will hit mathematically critical levels within months, not years. And mathematically critical means there simply will not be enough metal to honor the delivery demands. When that moment arrives, the exchange will face a binary choice: deliver the metal they do not have, or settle in cash and admit the paper market was a fiction. Fourth, do not let the noise shake you out of your position. Today's price dip was engineered. Tomorrow's price dip might be engineered too. The institutions that are short this market have billions of dollars at stake, and they will fight with every tool they have. They will smash the price, they will plant negative stories, they will use algorithms to trigger stop losses. They will do everything in their power to separate you from your metal. But they cannot create silver, they cannot mine it faster, they cannot undo the deficits, they cannot reverse the industrial consumption, they can manipulate the price temporarily, but they cannot change the physics of scarcity permanently. And fifth, understand where you stand in history. Every great wealth transfer begins with a period where the mainstream tells you the opportunity is over, while the data tells you it has barely started. We are in that period right now. The mainstream says silver is overbought. The COMEX says 70% of the inventory is gone. The Silver Institute says 4 straight years of deficits. The US government says critical mineral for national security. Listen to the data. Ignore the commentary. Today, 3.7 million ounces of silver left the COMEX vault. That is not a headline. It is a signal, a quiet, persistent signal that the physical market is separating from the paper market in ways that cannot be reversed. I started this video by telling you to stop what you were doing. I told you this data point mattered. And now you understand why. Not because of what it means today, but because of what it confirms about tomorrow. The silver is leaving. The vaults are thinning. The demand is structural. The supply is constrained. And the people who hold the physical metal are positioned on the right side of the greatest supply imbalance in modern commodity history. The world is noisy, the markets are chaotic, but the data is clear, and the quiet investor follows the data. Hold your position, trust the fundamentals. Let the noise pass. I am the quiet investor. Stay calm, stay informed, stay ahead. If this analysis helped you see what the mainstream will not show you, consider subscribing and sharing this video with someone who needs to hear it. I will see you in the next one.